Hi everyone, Happy New Year and welcome to Symax Fintech Weekly Market Insight. As usual, we'll start off with our disclaimer. So trading involves potential risk of loss of capital and is not suitable for everyone, but as I always say, hopefully it is for you. Many companies provide leverage, so you just got to be aware that you can lose substantially more than that initial investment that you make. Views, opinions, everything that we include in these is just purely for educational purposes and does not constitute in bias. It's not, we're not encouraging you to trade or invest. That has to be your decision. And before you make that decision, you should carefully consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, you should only risk capital you're prepared, but more importantly, that you can afford to lose. Any doubts whatsoever, seek financial advice from an expert, and of course do that before you risk your capital. Okay, so as I said, Happy New Year. Wishing you health, wealth and happiness. Welcome back to our weekly YouTube. That's going to prepare you for the week ahead, and of course we provide these every week, so all throughout the year, so hopefully we'll see you again, and these do help you. So the first thing, when we look back at last week, the Fed minutes. So, their resolve to tame inflation will not waver in 2023. And, you've got to be prepared and warned about that. Data is going to be the key to how aggressive it becomes if they slow down, which they will do. Last year, very, very aggressive with their rate increases. This year, I feel that there still could be some more. It's just that they're going to be smaller. And then, even once they've made these rate increases, they're not going to quickly turn around. And I'll cover that more in the macro outlook. Okay, so while we're on the Fed, the FOMC, they have this rotation where they replace members each year. So 4 members have been replaced, and that includes Bullard and Mester, which, I admired them. I had a lot of respect for their comments and their decisions. So, over time that you could see a sort of a different balance, Hawks versus Doves. So just keep an eye out for that. When it came to ADP, it was much higher than expected. It came in at 235,000. NFP came in at 223,000. As I say, they were both higher than expected. Earnings and hours worked dipped slightly though. And the unemployment rate returned back to the 3.5%. This is the lowest that they've had it since I think about something like the 1960s. But of course, that will include some holiday season hires. PMI was slightly lower and job openings increased again. ISM dips below 50. So above 50 is expansion. Below that is not necessarily bad, a contraction or anything like that. It's really got to get below 45, 43 to really signal that. So it was only just below 50. For the UK, strikes and unrest remain a challenge. It's unfortunate that it's happening for this country. I'm in the UK, but it's a challenge for the government. Inflation sticky and recession could be deep and long. Mortgage approvals have declined and house prices dropped 1.5% in just a month. For the EU, PPI year on year dropped to 27.1% and CPI 9.2%. Inflation dipped below 10%. So a lot of this has been helped by the seasonally mild weather. It's reduced demand for power, so the prices have come down there. Food inflation, unfortunately, remains very high. I think in Germany, it's something like around 20% at the moment. And German retail sales are down as well. They were down 5.9% year on year. Over the sort of holiday season, if you like, gold rallied, oil has recovered over the last few days. Stocks just impacted by data now at the moment. And the USD strengthened again at the end of last week, although it gave a little bit back Friday afternoon. And while we're on the US, so McCarthy, it took around 14 attempts for him to become the speaker, and he had to make many concessions to actually get voted in the end. So yeah, the speaker is a very important person in the US. So and yeah, so that's about it for last week. Moving on to this week, it's really about that data for inflation again. So the US CPI, if you trade commodities, we've got the USDA report coming out, Fed inflation expectation index, and the Michigan consumer sentiment. In the UK, retail sales, GDP, manufacturing. In the EU, industrial production and regional CPI, so country by country. And in China, CPI as well. In Australia, CPI, retail sales, and the trade balance. So again, all eyes on inflation, and it's going to remain that way. So, that's just because we've had a holiday doesn't mean that anything's changed really. It's just going to be a very interesting year, and there's going to be some twists and turns. So when we look at the macro, as I mentioned, central banks are determined to regain control of inflation, even at the cost of a recession. US remain in a strong position. During COVID, the Fed and Biden were in unison on stimulating the economy. Now it seems that they're on opposite sides of the fence. Biden's still pushing through some of these inflationary policies of his, while Powell is obviously trying to raise rates in an attempt to get inflation back down to that 2% target level. And although inflation is dropping and investors are getting excited about that, it still has a long way to go. Now, even if when we get back to that 2%, and I'm not even sure whether we can make it in 2023, we'll have to wait and see. But, do not expect rates to suddenly start to get cut again. The Fed's going to want to see 3 to 6 months of inflation around that 2% target level before they even consider trimming rates. And I mean trimming them, I don't mean cutting. And it's important to remember that zero and low rates are for a crisis, and they're not the norm. They're not what we should be used to or expect. So just be careful of that. And any future reductions will be controlled and incremental. Then unless there's a massive crisis where they perhaps will cut sharply again. Otherwise, any sort of undoing of all these massive rate rises that we saw in 2022 are going to be slow. And for me, they're being quarters. They've gone up very sharply, but they're not going to come down anywhere near. And I think, that's if they need to reduce them at all. And just remember now, I would say cheap money is history. It's something that was there and gone, and it could be gone for a long time now, especially for the foreseeable future. Especially, I believe, as inflation has really spooked central banks. And, it will live in their memory for a long time yet, and that's going to make them much more cautious with any rate cuts. So when we look at stagflation, I think that will hit many countries. For those of you new, inflation without growth effectively is what stagflation is, before it turns into full-blown recessions. Of course, a lot of that will depend on energy prices and food prices. At the moment, especially in Europe, we have that mild weather, and it is removing some of the pressure from energy prices. Now, a major concern for me, and something that I'm really going to focus on, especially in the first quarter or first half of this year, is China removing their COVID zero policy. There was also 1 or 2 new strains that seem to be appearing. Now, on one hand, we could see demand increase. Again, it's going to be inflationary just because China coming out of their lockdowns. Just think what happened to most of the rest of the world when it happened. That buying demand came in. But then again, on the other side of that, we've got this sort of self-isolating as cases are hitting record levels in China. That's leading to staff shortages, and then that could become serious for supply chains. I've heard that some factories are actually keeping their staff on site to reduce risks. Now, supply chains being at risk again, again can be inflationary. You could see shortages coming back. It remains to be seen. But China is a real main focus for me, probably more so than the war at the moment. So Russia's taken to aerial attacks to try and break Ukraine. They've been doing this for the last few months now, but becoming more aggressive where they're hitting utilities such as water and power in many cities. But Ukraine continued to take the fight to Russia. And, they're sort of battling all their forces in their occupying territories. And I would say with really great success at the moment. Food inflation still seems to be the biggest threat to me. In my mind, there's a lot of it is profiteering by the companies and by the supermarkets. That's just my personal opinion. And when you look at it, because many of those costs from the war and COVID and all that, they have settled back down to those pre-levels. The only things I would say are probably that haven't are wages and the power prices.